Welcome to StokTok's deep dive into Dell Technologies. Dell Technologies is one of the world's largest manufacturers of personal computers, servers, and enterprise infrastructure solutions, serving both consumer and institutional markets globally. At the time of recording, Dell Technologies is trading at $215.97 per share. The stock has moved up 4.9% recently and sits near its 52-week high of $219.26. The 52-week low was 86.76, meaning the stock has recovered substantially from its lows. The price is trading above its 50-day moving average of 162.22, which is also above the 200-day moving average of 139.15. This suggests an uptrend is in place. However, the Relative Strength Index, or RSI, sits at 72.5, which is in overbought territory. This means the momentum indicators are stretched. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. Dell Technologies generates revenue primarily through the sale of computing hardware, servers, personal computers, storage systems, and networking equipment. The company also derives significant revenue from services, solutions, and software. Their competitive moat rests on brand recognition, established enterprise relationships, and a broad installed base that creates switching costs for customers. However, in our view, this moat is moderate rather than fortress-like. The hardware space is competitive, and margins are under pressure from commoditization. The StokTok score for Dell Technologies is 33 out of 100, which signals caution. Breaking this down across 5 dimensions, valuation scores 3 out of 20, indicating the stock appears expensive relative to fundamentals. Financial health scores 10 out of 20, suggesting some structural concerns. Profitability scores 7 out of 20, showing modest but compressed margins. Growth scores 5 out of 20, reflecting slow top-line expansion. Smart money scores 8 out of 20, indicating that major institutional holders are not aggressively buying. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, Dell Technologies trades at a trailing 12-month price-to-earnings ratio of 22.54 times. This is above the tech hardware sector average, which typically trades in the 14 to 18 times range. The forward price-to-earnings ratio, which looks ahead, is 15.22 times, suggesting Wall Street expects modest earnings growth near term. The price-to-earnings growth ratio, or PEG, sits at 5.00. A PEG above 2 is generally considered expensive on a growth-adjusted basis. This suggests that Dell's growth rate does not justify its current valuation multiple. The EV to EBITDA ratio, that is, enterprise value divided by earnings before interest, taxes, depreciation, and amortization, stands at 12.20 times. For hardware companies, this is moderately elevated. The price-to-sales ratio is 1.18 times, which is reasonable but not a bargain. Now, on the economic moat. In our view, Dell operates in a functionally commoditized market. Personal computers and servers are increasingly price-sensitive commodities, especially in cloud environments. While Dell has relationships and scale, the competitive advantage has eroded over the past decade. Pricing power is limited. Switching costs exist but are not prohibitive. GuruFocus Value, a valuation model maintained by the institutional research platform GuruFocus, pegs Dell's intrinsic value at $149.19 per share at the time of recording. The current price of $196.55 represents a premium of negative 31.74%, meaning the stock is trading at a 31.74% discount to that model's estimate. However, we should note that this GuruFocus value estimate may not capture current market dynamics or the full weight of growth factors. Wall Street analysts, at the time of recording, have a consensus mean price target of $187 per share across 23 analyst estimates. The high target is $246, and the low is $110, reflecting significant disagreement about fair value. The next earnings report is due May 28, 2026, with the street expecting earnings per share of approximately $2.94, with estimates ranging from 2.85 to 3.05. This is a near-term catalyst. Market sentiment around Dell Technologies, as of the creation of this video, leans bullish. Analysts are praising the company's positioning in artificial intelligence infrastructure, cloud computing, and the leadership vision of CEO Michael Dell. This positive sentiment may be supporting the current valuation. In our view, however, the valuation setup presents a risk-reward that favors caution. The stock is not cheap on a PE or PEG basis. Momentum is stretched per the RSI, and Wall Street's consensus price target sits below the current trading price. This is the structural setup of a name that may struggle to justify higher valuations without significant operational momentum. Moving to financial strength, how solid is the foundation? The Piotroski F-score is a 9-point checklist that evaluates the quality of a company's financial position based on profitability, leverage, and operational efficiency metrics. Dell Technologies scores 7 out of 9 on the Piotroski scale, which is solid. This indicates that most of the underlying financial health indicators are positive. However, a score of 7 is not exceptional. A score of 8 or 9 would indicate a truly fortress-like balance sheet. The Altman Z score is a bankruptcy risk model that combines 5 financial ratios to estimate the likelihood of insolvency. Dell Technologies scores 2.12 on the Altman scale. Z scores above 3 are considered safe. Scores between 1.8 and 3 are in the gray zone, meaning there is elevated financial risk, though not imminent distress. A score of 2.12 places Dell squarely in the gray zone. This warrants caution. Now to debt and liquidity. Cash to debt is 0.37, meaning the company has only 37 cents in cash for every dollar of debt. This is a constraint. A healthy ratio is typically 1.0 or higher. The debt-to-equity ratio is negative 12.75, which reflects a capital structure with significant net debt. Interest coverage is 5.27 times, meaning operating earnings cover interest expenses 5.27 times over. A ratio above 3 is generally acceptable, so Dell passes this test. However, the current ratio, that is, current assets divided by current liabilities, is 0.91. This is below the ideal threshold of 1.0, suggesting the company may face near-term liquidity constraints if it encounters operational stress. Overall verdict on financial strength. Dell's balance sheet is not broken, but it is not fortress-like either. The gray zone Z-score, the tight current ratio, and the limited cash relative to debt all signal that management must prioritize balance sheet preservation. There is not much room for a significant operational stumble without raising capital or cutting dividends. Next up, profitability. Is this business actually making money efficiently? The return on invested capital, or return on invested capital, is 10.56%. Return on invested capital measures how effectively management deploys shareholder capital to generate profits. A return on invested capital above 10% is respectable, and 10.56% suggests Dell is generating reasonable returns on the capital deployed. However, in a competitive hardware market with limited pricing power, this return is not exceptional. For context, best-in-class technology companies often exceed 15 to 20% return on invested capital. Now let's move through the margin stack. Gross margin, which is revenue less the direct cost of goods sold, is 20%. In the hardware business, 20% gross margin is typical. The company is not losing money on unit economics, but there is limited room for expansion here. The gross margin reflects the commoditized nature of the business. Operating margin, that is, earnings before interest and taxes divided by revenue, is 7.27%. This means that for every dollar of revenue, about 7 cents flows through to operating profit before financing costs and taxes. 7.27% is compressed. Best-in-class software or services companies often command operating margins of 30 to 40%. Operating margin for hardware manufacturers typically ranges from 5 to 10%, so Dell is in the middle of the pack. Net margin, which is net income divided by revenue, is 5.23%. This is the bottom line. After all costs, interest, and taxes, Dell retains about 5 cents per dollar of revenue as profit. This is modest. Finally, free cash flow margin, which measures the percentage of revenue converted to free cash flow, the cash available after capital expenditures, is 7.53%. This is healthy and indicates the business is not capital intensive. Dell generates cash despite thin net margins, which is a positive. The profitability picture. Dell is profitable and cash generative, but margins are compressed and returns on capital, while respectable, are not exceptional. The business is running at a sustainable but not spectacular level of profitability. On to growth. Is this business expanding and at what rate? Revenue growth over the trailing 3 years stands at 3.5% annually. This is slow. For context, inflation over the past 3 years has hovered around 3 to 4%, meaning Dell's organic growth is barely keeping pace with inflation in nominal terms. Revenue growth over the trailing 5 years is 5.6% annually, which is also slow. The company's top-line expansion has not been robust. Book value growth, that is, the growth in shareholder equity per share, over the trailing 3 years is 4.6% annually. This is also modest. It suggests that the company is not reinvesting earnings at particularly high rates of return, which aligns with what we observed in the profitability section. The dividend yield is 1.07%. This is a modest income stream. The overall growth picture is one of deceleration and maturity. Dell is in a slow growth phase. The business is not expanding meaningfully, and there are few signs of a significant growth inflection in the near term. The data suggests that Dell operates in markets, personal computers and enterprise servers, that are mature and growing slowly, if at all. This is a core constraint on the investment thesis. If growth is not accelerating, then valuation multiple expansion becomes the only path to capital appreciation, and that path is narrowing given the current stretched valuation. This is a headwind. Now let's talk smart money. What institutional capital is actually doing with this name. 13 top-tier Guru investors, also known as super investors tracked by the Dataroma platform, currently hold Dell Technologies. However, the direction of their positions is revealing. First Pacific Advisors, which holds Dell at 0.65% of its portfolio, has reduced its position by 8.49%. Dodge and Cox Funds, another institutional holder, has reduced its position by 18.83%. These are not token reductions. This is significant trimming by sophisticated capital. Only 9.7% of 13F filers, that is, institutional investors who file quarterly holdings reports with the SEC, are net buyers, owning more than 50% of their total holdings in increasing positions. This means approximately 90% of institutional filers are either holding steady or reducing. Insider ownership stands at 3.31%, which is moderate. Executives have some skin in the game, but not overwhelming personal capital at risk. Most telling, insider transactions over the last 3 months show 0 buys and 29 sells. 0 buys and 29 sells is a stark signal. Insiders are liquidating, not accumulating. This behavior typically precedes weakness. When the people closest to the business are systematically selling, the market eventually takes notice. The smart money picture is negative. The largest institutional holders are trimming. Insider activity is showing weakness. Institutional participation in the stock is not robust. This is a major yellow flag that contradicts the bullish sentiment we noted in the valuation section. The combination of insider selling and Guru reduction, alongside tepid institutional participation, suggests that the smart money does not believe the current valuation is justified by near-term catalysts. And finally, the verdict. Let's bring it all together. On valuation, the stock is trading at a stretched multiple, 22.54 times trailing earnings with a PEG above 5, while Wall Street's consensus price target sits below the current price. This is not a compelling entry point. Financial strength. Dell sits in the gray zone on bankruptcy risk, with a tight current ratio and limited cash relative to debt. The balance sheet is functional but constrained. Profitability. The company is cash generative and shows a respectable 10.56% return on invested capital, but margins are compressed at 5.23% net margin. The business is mature and moderately profitable, not exceptional. Growth. Dell is expanding at only 3.5% annually over 3 years, barely keeping pace with inflation. Top-line momentum is absent, which means the company has no organic growth tailwind to support a premium valuation. Smart money. This is the most damning signal. The largest gurus are cutting positions. Insiders are selling 29 shares with 0 buys. Institutional participation is weak. The people closest to the business are voting with their feet. Our interpretation of this data: Dell Technologies is a mature, slow-growth hardware company trading at a stretched valuation. The company generates cash and is modestly profitable, but has limited pricing power and faces headwinds from commoditization. Near-term catalysts exist: the May earnings report and ongoing enthusiasm around AI infrastructure. But these are not sufficient to overcome the fundamental constraint. A business with low single-digit organic growth cannot justify a 22 times earnings multiple. The structure of the setup favors caution. The smart money is heading for the exits. In our view, this is a name to avoid at the current price and momentum. If the stock corrects materially to a price where the valuation multiple compresses meaningfully below 15 times earnings, the risk-reward would improve. But at the time of recording, the setup does not justify exposure. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Dell Technologies. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.